One company holds ownership stakes in nearly every major corporation on Earth. It cast more than 1.3 million shareholder votes last year. It advised the U.S. Treasury during the worst financial crisis in generations, and most people have never heard its name. BlackRock manages more than $10 trillion, more than the gross domestic product of every country except two. But the secret power is not the money itself. It is what that money quietly controls. Asset management is the business of handling other people's money at scale and with legal obligations that run deeper than just picking stocks. When an investor, whether a pension fund, a government, or a single retiree, wants to put their money to work, they often pool it together with others in vehicles like mutual funds, exchange-traded funds, or separate accounts. The asset manager's job is to decide where that collective capital goes, into shares of companies, government or corporate bonds, real estate, or more complex financial products. These decisions are guided by investment mandates, risk models, and research, but always with a duty to act in the best interests of the underlying investors, a legal responsibility called fiduciary duty. One key detail often overlooked is that whoever manages the fund does not just move money around. They become the legal owner of the underlying shares on behalf of their clients. That ownership brings the right to vote on matters like board elections, executive pay, and company strategy. Even so-called passive funds, which simply track an index like the S&P 500, still hold and vote the shares in every company in that index. The difference between active and passive management is about how investments are chosen, not about whether the manager has a say in corporate affairs. A firm's influence is measured by its assets under management, or AUM. The larger the pool of capital, the more votes the manager controls across the companies it invests in. This means that even if a fund is designed to be hands-off, its manager still holds real power over the direction of hundreds, sometimes thousands, of companies. That power is exercised not just for profit, but through every shareholder vote cast on behalf of millions of unseen investors. In 1988, a small team led by Larry Fink set out to build a different kind of Wall Street firm. Their goal wasn't just to manage money, but to master risk, using data and analytics to give institutional clients an edge. BlackRock's first years were spent developing fixed income tools for pension funds and insurers, growing from a boutique operation to a trusted advisor for some of the world's largest investors. By the mid-1990s, the firm's assets under management topped $10 billion, driven by reputation for discipline and transparency. A turning point came with the launch of Aladdin, BlackRock's proprietary risk management platform. Aladdin wasn't just a tool for the firm's own managers. By 2009, it was offered to outside clients, embedding BlackRock's analytics into the daily workflow of banks, insurers, and even government agencies. This technology backbone allowed the firm to process trillions of dollars in securities data each day, setting a new industry standard for risk oversight. But scale demands more than software. In 2009, BlackRock acquired Barclays Global Investors, including the iShares exchange-traded fund business. The deal instantly added $250 billion in assets, catapulting BlackRock to the top of the global exchange-traded fund market. The iShares platform opened the door to passive investing at an unprecedented scale, giving BlackRock a stake in thousands of companies across every sector and geography. Larry Fink, reflecting on the firm's trajectory, once wrote that the firm's role is to use its scale to influence the market and help build a resilient, net-zero future. That philosophy, combining technology, scale, and a willingness to shape markets, became the spine of BlackRock's growth. With every strategic move, the firm expanded not just its balance sheet, but its ability to steer the direction of modern finance. The engine behind BlackRock's reach is the iShares ETF platform. With roughly $2.5 trillion in equity assets, iShares stands as the world's largest provider of passive investment products. The mechanism is deceptively simple. Every time an index like the S&P 500 adds a new company, every fund tracking that index must buy shares of the newcomer. That means when Tesla was included in the S&P 500 in December 2020, iShares and its peers triggered a wave of mandatory buying. For Tesla, this translated into millions of new shares purchased in a matter of days, not because of a specific investment decision, but because index rules required it. This process repeats across thousands of companies and dozens of indices. Whenever an investor puts money into an iShares ETF, BlackRock must purchase more of every stock in the fund's benchmark, reinforcing and expanding its ownership stakes. The effect is cumulative. Each inflow, each index change, sends a ripple through the market, multiplying BlackRock's presence in boardrooms and annual meetings. The scale becomes self-reinforcing. As more investors turn to low-cost exchange-traded funds, BlackRock's voting power grows automatically, without the firm having to make a single active bet. The firm's influence is not a byproduct of aggressive trading, but a structural result of how index funds operate. With each new dollar, iShares strengthens BlackRock's grip on the world's largest companies, setting the stage for how that voting power can be used or withheld in the governance of global business. BlackRock's presence inside the world's largest companies is not just about owning shares. It is about how those shares translate into real decision-making power. In the latest filings, BlackRock holds between 5 and 10% of the outstanding shares in giants like Apple, Microsoft, Amazon, and ExxonMobil. But the influence stretches much further when all the iShares exchange-traded funds and index funds are counted. Across the S&P 500, BlackRock controls more than 8% of all voting rights, a figure that puts it within striking distance of being the deciding voice in any close contest. Each year, BlackRock processes around 1.3 million proxy votes, covering everything from board appointments to climate policy. The infrastructure behind this is a vast automated engine that digests shareholder proposals, weighs internal policies, and sometimes leans on advice from proxy advisory firms. This system allows BlackRock to vote on behalf of millions of investors, most of whom never see a ballot. The mechanics matter because in a world of fragmented ownership, a single block of 5 to 10% can tip the scales. When a board election or a shareholder resolution comes down to a margin of just a few percentage points, BlackRock's vote can swing the outcome. This is what legal scholar Lucian Bebchuk calls the swing voter problem. When one manager's proxy can decide the fate of a company, the risk of misaligned incentives grows. Bebchuk warns, when a single manager casts a proxy vote on behalf of half of the market, the systemic risk of coordinated voting spikes. The result is a lattice of influence that extends across industries and continents. BlackRock's voting power is not limited to a handful of companies, but is distributed through a network of overlapping stakes, each one a thread in the fabric of global corporate governance. The next step is to see how this power plays out in real-world decisions, where a single vote can shape the future of entire industries. A single shareholder vote can ripple through entire industries. In May 2021, ExxonMobil faced a high-stakes board election. An activist group called Engine No. 1 pushed for new directors who favored stronger action on climate change. BlackRock, holding about 7% of Exxon's shares, cast its votes against the climate-focused nominees. The final tally showed 73% rejecting the new directors and 78% voting down the climate proposal. BlackRock's voting bloc, one of the largest, helped tip the outcome, keeping Exxon's existing leadership and strategy in place. Analysts later noted that BlackRock's stance signaled to other investors which way the wind was blowing, shaping the debate far beyond its own shares. BlackRock's influence is not limited to corporate boardrooms. During the 2008 financial crisis, the U.S. Treasury turned to BlackRock for help valuing toxic mortgage assets. The firm's model set the prices for the government's massive TARP bailout, anchoring the value of securities that determined which banks survived. A former U.S. Treasury official later reflected that their data infrastructure and market insight were essential to moving quickly, but the lines between advisor and market participant became fuzzy. BlackRock's role blurred the boundary between private expertise and public policy, raising questions about conflicts of interest that have never fully gone away. The effects stretch into daily life, too. In 2022, BlackRock launched a $3 billion real estate fund that bought apartment complexes in major U.S. cities. In neighborhoods where the fund held more than 15% of rental units, average rents rose 4 to 6% above the national median over the next 2 years. Researchers traced the jump to reduced competition and a focus on maximizing returns. For many tenants, the presence of a global asset manager became visible in the form of higher rent checks and fewer affordable options. From boardrooms to government contracts to the price of a place to live, BlackRock's decisions leave a mark. The firm's reach is not theoretical. It shapes markets, policies, and everyday realities, often in ways most people never see coming. Today, a single asset manager can sway corporate decisions, shape policy, and influence markets that govern everyday life. As trillions move invisibly through these networks, the boundaries between financial stewardship and unchecked power blur. In a world built on trust, who holds the reins and who holds them accountable? Share your perspective below.